I'd like to actually take this time and thank the team at GP, not only for setting up today's call, but also really just being fantastic partners of ours. Also on the call with me is my internal partner, Ryan Polikas. Ryan is really a fantastic resource and member of our team. Ryan comes from or has a similar background and is following a similar path to me as far as his role, his understanding of whole life, positioning, strategy, et cetera. So what we are going to do today, this is going to be call number 1 of 3. The goal is to go 30 minutes, including question and answer. All right. We're going to have one next week, and I believe one the following week. But today's discussion is really going to be an introduction or maybe a reintroduction. All right. Next week, we're going to talk about the accumulation. We're going to talk a little bit more about identifying the client. We're going to talk a little bit more about the strategy. After that, we'll talk about whole life and the protection sale. All right. So what we have set up today, we have got a Q&A. All right. I'm going to ask either Melinda or Ryan to kind of monitor that Q&A. Ryan knows this better than most. I kind of get into a zone and won't see it. So if you look, it's either on the top or the bottom, or it's on the control panel, and it'll say Q&A. So if you've got a question as we're going through this, we will go ahead and stop and ask for questions. So I know we may be having a little bit of trouble with some folks getting into into the call.
Yeah, Chris said he's having technical difficulties as far as audio.
Okay.
But and Ryan, if you want to go ahead and monitor, if you're monitoring the chats,
I've got it.
Okay, cool.
Okay. So what we're going to do for everyone that's on the call, ready to go, what I want to do to make sure everyone knows where the Q&A is, I want to start off with a trivia question. Just so everyone, like I said, can be familiar with Q&A and feel comfortable asking a question. The winner of the trivia question, so the first correct answer, I will send you a MassMutual Yeti cup. Okay, with summertime coming up, that'll either be great for a coffee or another type of beverage you might want to keep cold. So, it's going to be movie trivia. So in 1992. There was a movie released in which Vincent Gambini was an attorney. Name the state in which he won his first case. All right. First correct answer will receive the Yeti, and I'm watching it now to see what we've got. Let's see.
We've got someone who popped into the question and answer.
Hey, Mike, not New Jersey.
We've got Mass.
Nope.
Alabama from John Yosh.
John, that is the correct answer.
Right.
If John was first.
John was first.
Okay. So a lot of times people will say, no, it was a parking ticket in New York. No, that was actually the judge that convinced him to become an attorney. The first case that he actually won was in Alabama. So you shoot a good old boy in the South, you're going to court. All right, so let's go ahead. We've taken enough time. So if you got questions, ask them there. We're going to go ahead and get things underway. So today, let me get my kind of view set up. Perfect. So today is part 1. This is once again an introduction to whole life, or a reintroduction, if you will. Next week, the following week, we'll talk about whole life and the accumulation sale, as well as protection. Also, is a housekeeping item. You may be able to notice, I promise you, I'm not in my kitchen right now. I'm actually at the Marriott here in Clearwater. So I'm hoping nobody walks in the door behind me. I've got the do not disturb, but in the event they do, hopefully everyone knows what's going on. So let's go ahead. Let's hop into it. What we are going to do today is, one, we're going to let everyone know what MMSD is, MassMutual Strategic Distributors, and what that means for your business, for your practice. We'll hit on past, present, and future carrier products. And then we'll get into the meat of today's discussion, which is going to be whole life myths and misconceptions. And this is a great way, once again, to just get everyone back up to speed on what we're offering. Now, as far as MassMutual Strategic Distributors, now this is a dedicated channel that is 12 months old. All right, we launched with the team at GP about 10 months ago, and the partnership could not have gone any better. This is a $250 million commitment from MassMutual to support your business, to support brokerage, third party, whatever you want to call this. Now, with the team at GP, Melinda, Chris, Angela, you now have a direct contract to MassMutual. Now, prior, that contract would go through that local general agency. Now, through the team at GP, you have direct contract to home office. In addition to that, you have a dedicated wholesaling team that's led by Lisa Todd and Dave Reynolds. That gives you access, obviously, to myself as well as my internal partner, Ryan Fleekus, and we are dedicated to supporting that team over at GP who's dedicated to supporting you. We've got a fantastic team of advanced case design and marketing specialists. That team is led by Randy Zipsey, a well-known name within the industry, along with Sam Barton. So whether it's business owner solutions or whether it's premium financing, whatever it may be, we've got an outstanding team to help you with those cases and the team at GP. We've got seasoned and dedicated underwriting led by Roger Hergenrader. Roger Hergenrader has spent his entire career within brokerage. Now, I think this is very important to talk about that many of the underwriters that we have brought on all come from other carriers and all have a background in brokerage, and they understand underwriting from that perspective. Okay, so very confident in our team. In addition to our underwriters, we have all case managers that come over with a background in brokerage as well. I know it sounds a bit repetitive, but the big takeaway here is we understand what all of you need to be competitive. And that's why we built this team really with all of you in mind. So getting into a little bit more of today's presentation, we'll start talking about kind of past, future of product evolution. Now, I kind of want to pause here a little bit and say that the goal of today's discussion is not Matt Eller and Ryan of MassMutual to come in and say, hey, you know what, stop what you're doing. Stop selling UL, stop selling term, stop going V, whatever it is you may offer. That's not the goal. Instead, what we are trying to do is we are trying to open all of you up to that 30%. So what that 30% is, if you look at permanent life insurance sales within our industry, whole life sits atop by way of premium at number one at a 30% market share. So the goal here is if you're not writing whole life, if you're not incorporating it for your clients, that's the goal. Let's grow your practice by incorporating whole life. And then if we look at the environment today, a lot of volatility in the markets, right? We'll talk a little bit why whole life is compelling for that. Also, interest rates go up. That's a positive for our general account. So we talk about some of the concerns with the interest rate environment as well as the markets. Whole life can be a solution for that. Now, going back to kind of the evolution, if you will, of products, really from the 1950s until the early 70s, whole life was really the traditional, the primary permanent life insurance product. When we saw the 10-year Treasury skyrocket in the late 70s, that's when UL came into play. Obviously, from the 1980s until now, we've been on this downward interest rate environment. But in the 1990s, we saw the equities start to outperform, start to boom, and then we were introduced to VUL. Well, all it took was a couple of corrections in the markets, a couple downturns. I mean, I say a couple, but a lot more than that, whether it's 99 and 2008. And then we introduced IUL, right? And we as an industry. And so the reason why I bring this up is to show that really whole life has stood the test of time from 1956 until today. And so we're going to hit on that not only today, but also in some of these other presentations that we're going to be holding. So why is it important? Why did MassMutual launch this channel? Number one, as I mentioned, whole life has historically been the industry's number one selling product, okay? Independent distributors such as yourself, so not necessarily captive agents, have been the number one or prolific distributors of life insurance. However, independent distributors sell little to no whole life. So why is that, right? And then when you look at the landscape of the carriers, product availability, it makes a little bit more sense. So MassMutual took this as an opportunity really to come in and seize the opportunity, if you will, within that independent for independent distributors. All right. Now, as far as past, present, and future changes with carriers, we've seen a lot within our industry, and unfortunately, we've seen kind of a little bit as of recent. Sure, it's calmed down a little bit, but we've seen carriers exiting. Right, we've seen demutualization. Obviously, we're going through that with another carrier right now. Not we, but as in regards to the industry. So we are seeing an influx of clients considering making the change over to MassMutual because of that demutualization aspect. We've seen a lot of spinoffs, private equity ownership, which remains to be seen as far as the future and the impact that that's going to have. Obviously, we saw a big change with a stock whole life company a number of years ago, and kind of the changes that have come ever since that. We've seen some carriers focus on term and accumulation VUL. And then we've also faced a reduction in case capacities, right? So at the moment, by way of base premium, we do not have any limitations as far as designs are concerned. I always think it's important to hit on this when we talk about all of these changes that we've seen within the landscape of different carriers. That March 1st of last year, we launched MassMutual Strategic Distributors. I was wholesaler number 1 of 3. And it's wild to think, in the middle of a low interest rate environment, in the midst of a pandemic, MassMutual launched MMSD Strategic Distributor. So while you're seeing some carriers get out of the game, some carriers limit products, what did MassMutual did? We made a $250 million commitment to your business to go after that opportunity to increase the business for all of you. Now, the kind of meat and potatoes, if you will, of what we're going to talk about, some of the myths and misconceptions that some of you might have regarding whole life, but this is also going to be an educational piece as well, or a refresher. Kind of a lot of the pushback that I receive, number one, is it's too expensive. The second, compensation is far less for whole life than universal life products. Whole life is inflexible. Dividends are complicated and too hard to explain. And getting distributions out are expensive and difficult, okay? In regards to number one, expenses are certainly relative. With whole life, you get 3 guarantees: guaranteed premium, guaranteed death benefit. Sure, there are other products out there that offer those same 2 guarantees, but what you don't have is the third one, guaranteed cash accumulation. So on a worst case scenario, MassMutual can protect every single dollar that a client puts into that contract that eventually they will be able to take out on a worst case scenario. So when we look at, once again, today's landscape, this is going to be that conservative bucket for the client. This is going to be that bucket that where we can once again protect every single dollar that a client puts in. It's also very compelling to think about these guarantees, because when you think of how a product is manufactured, right? How is a product built? When you look at whole life, it's built on all guarantees. It's based on MassMutual not paying a dividend, something we've done for 154 consecutive years. It's based on maximum mortality expense charges, all right? Think of that on the opposite side of how a UL product is designed, right? It's designed based on a non-guaranteed crediting rate, whether it's an index or a UL. And then when you look at the guaranteed side, things get a little bit wonky, let's say. So from a whole life perspective, it's built on guarantee. Everything above that, favorable mortality, favorable expenses, and 154 consecutive dividend. We're in the South, so we call that just gravy, everything above it. And that's really what drives the cash accumulation, as well as that increasing death benefit by way of paid up additions. Compensation. I get this all the time. Compensation for whole life is less. If you're simply looking at year one, then yes, but we're not just looking at year one. So in this example, we're assuming a male age 45, and they're looking at our flagship 10-pay whole life product. They're going to be putting in $100,000 for that 10-year premium duration. At the end of 10 years, it's guaranteed paid up. This isn't the early 90s, late 80s where we're talking about vanishing premiums. These policies are designed to be guaranteed to be paid up within that duration. Now, in this example, we're going to assume the IUL is going to utilize, the industry average, let's say a target of 41,000. All right. And then we are going to compare that to our 10-pay whole life, which pays out 55% of target and then 5% of excess. Year one, you are down. But year three is really where you start to catch up. That is your break even. All right. And then by year 10, you'll notice there is a substantial difference in compensation. So a 39,000 versus 66,000 in comp. So there is more to the story, and it is certainly, it's not the only reason why we do it. It's not the main reason, but it's definitely something that we need to make sure that everyone is fully aware of. Is do not get caught up on year one. We are very favorable as it pertains to renewals as well as an excess in years 2 through 10. Whole life isn't flexible. I always love this one. All right. We have got multiple riders to customize the policy. If we're looking for more cost-effective death benefit, we can blend term. We've got 2 different riders that we can utilize for term, and that's always a day 2 kind of conversation with the team at GP or Ryan and myself. We can create a lot of flexibility with our riders. We can illustrate our 10-pay to be a 4-pay, to be a 5-pay, to be a 7-pay, so we're not stuck unnecessarily funding for 10 years. We've got the option to show guaranteed reduced paid up. What that means is, let's say a client's 8 years into the contract, and we'll illustrate this next week. Let's say a client's 8 years into the contract and they say, you know what, I just don't want to pay premiums anymore. Maybe I'm illiquid. What we can do is we can exercise a guaranteed reduced paid up, which means no further premiums. We take a reduced death benefit amount, but number 3, right, cash value. We preserve every dollar that goes into that contract, and it is still eligible to receive dividends. Additionally, we can illustrate utilizing the dividend to cover premiums. All right, so we've got that option as well. Dividends. This is the black box. This is the pushback that we receive majority of the time when it comes to our product. Dividends are complicated and too hard to explain. Dividends are simple. It is investment results. So the performance of our general account, the stocks, the bonds, the real estate, whatever debt we may be holding at that time, combined with our outside business earnings. All right, so other businesses that we invest in here at MassMutual. So we take those investment results, we minus out mortality, and we minus out expenses. All right, so that's the high level, investment results, minus mortality, minus expenses. The mortality and expenses is very important. Many times people are hung up on the dividend interest rate, right? What's Mass's dividend? That's what I always get. Our dividend is 6%. It's the same it was last year. All right. But if you look at an illustration from last year to this year at our same dividend of 6%, the illustration looks favorable this year. Why is that? Well, despite what you may hear, mortality was favorable for MassMutual last year. So our policy looks, once again, more attractive. Taking it a step further, here is how our dividend is calculated. We will not break this out outside of this page. So you can't ask for it on an illustration. But let's walk through it and we'll be able to simplify it. In this example, we're assuming an ending policy value, so a cash value of $23,736. We've got an annual premium of $2,800. So we're going to add that onto our cash value. We are then going to subtract out those mortality, expenses, and other charges of $477. So we pay a premium, subtract out our expenses. That gives us a net of $26,062. Our dividend, we know what the dividend is, 6%. We add in that 6%, that $1,500, and that takes us to $27,626. So think about that black box, right? Oh, there's so much going on. We can't see it. We don't understand it. There's only one piece of information that you do not know about a MassMutual illustration that's illustrated here. It's the mortality, expenses, and other charges, all right? And what I always say is that, hey, if you're good at Excel, I know that I'm not. I'd imagine Mr. Kerrigan is not either. You can probably figure out what those mortality expenses and those other charges are. Okay, so that's the black box. That's how we credit our dividend. All right. Getting distributions out from a whole life policy is expensive and difficult. I've always had trouble with kind of this point. Okay. Loans are available within the first policy year on our contract. With MassMutual, we'll talk about this a little bit more next week. We have the ability for a client to take out a variable loan that has a floor of 3% on our 10-pay. That's tied to Moody's corporate bond, or they can lock in a fixed loan rate at 6%. If you compare that fixed loan rate to other type of mutual whole life carriers within the industry, it is a very competitive rate. Okay. Clients have the ability to take partial surrenders. Maybe they don't want to take a loan. They just want to take out their cost basis. They have the ability to do that. Clients also have the ability to accelerate the death benefit or utilize a long-term care rider. We have a long-term care rider that can be added to any of our whole life products so that a client can make that death benefit a living benefit. So I think of it as wealth accumulation, wealth protection, right? Whether it's death benefit, whether it's long-term care, or finally wealth transfer. Okay, so easy to get these funds out. Right now, our 10-pay is very compelling because we've got a 6% dividend and the variable loan rate is currently at 3%. Okay, so just keep that in mind. And client has the choice of doing taking out loans, doing partial surrenders, or accelerating that death benefit. Okay, so to kind of bring everything back, we're looking great on time, and so hopefully we got a couple questions queued up. But ultimately, you know, the big takeaway here once again is how can we grow the practice, you know, by 30%? Okay, how can we incorporate whole life? How can we leverage the resources in GP to get all of you that direct contract with MassMutual? Okay, so before we kind of, I'll look in the chat, I'll see if we have any questions. What I want to do is I want to paint a little bit of a picture here for next week's call. Okay, next week's call is going to focus on accumulation. All right, so think about some of the clients or prospects that you have that are high income earners that are looking for additional ways to mitigate taxes. Okay, this can also include, but don't just think of these clients that are ultra conservative by way of investment personality. Okay, so high income, that's relative to where you live and spending habits. If you work with a doctor that makes $1 million and spends $1 million, not going to be the right fit for next week's call. So high income earners, strong savers, looking to mitigate taxes. They can be conservative risk tolerance, or maybe they just need something to balance out the portfolio. Maybe it's a client that's sitting in cash, whatever it may be. Okay. So what I will go ahead and do now is I'm going to look and see, as far as our LTC rider, is there, okay, so here's a question from Michael Huffman. Is the cost of the LTC rider broken out so it can be deducted as a long-term care premium? Yes, it is broken out by way of premium. Ryan handles a lot of our LTC. Ryan, are you available to provide any more detail on that as far as the cost?
I think what he's talking about when he's saying can be deducted LTC premium has something to do with taxes. Yeah,
okay,
and for that purpose, I'm not sure if it is deductible for tax purposes, but yes, it is broken out in the illustration so you can see what portion of your premium is going to be spent on that rider.
I'd say that you can deduct that premium for sure. We do it with other products. So with Mass, it's just broken down. It's a smaller percentage, but forgive me for I kept having technical difficulties here, Matt and Ryan.
It's good to have you.
Yeah, I was here. I just couldn't hear me. Anyway, but it does break it down so that you can get the tax deduction on that, especially in the next couple of weeks. We're coming up on tax time.
Absolutely.
And I've got to say, that one piece on the dividend breakdown, I've been doing this over 30 years, like a lot of the guys listening, ladies. That's the best looking piece I've seen yet on explaining what a dividend does or how it works. So I think we've done an awful job over the years, but I think that one piece has been the best I've seen in a long time. I'll mute myself again.
I don't have faith that you know how to mute yourself. It took you this long
at this
to
point.
unmute. And so let me see if we had one more question pop up. All right, so we've got that. And then how about the movie for the Yeti, My Cousin Vinny? So Tom made up his own trivia question in an effort to get that Yeti cup. All right, so let's see if we have, I think I saw something else pop up. Okay. So, I think, at this point, we told everyone, we wanted everyone to be on and off in 30 minutes. It's 11:30 now. I believe we've answered all the questions. I know Ryan and Melinda have been monitoring. So we're looking forward to hopping on next week. Once again, it's going to be accumulation focus. So tax deferred, tax free, non-correlated to the market, positive correlation to rising interest rates. So everything that's kind of going on right now, it's definitely going to be relevant. So thank you, team at GP, for setting this up, and thank you to everyone that joined in. And I really appreciate the partnership, and we look forward to talking with you next week. Have a great rest of your week.
To register, they can go to the homepage of our website and register there. So that's April 5th, and the next one's April 19th after that.
Excellent. All right. Thanks, Melinda. Be well.
Take care. Thank you.